Here, despite geopolitical concerns, the Nasdaq and the S&P hit new highs in yesterday's session. The S&P 500 is on pace for its sixth positive week out of 7, up 52% since the election of President Trump. Jim Paulsen on the Leuthold Group says look for the S&P to reach somewhere between 35 and 3,600. Jim joins us now, along with Rich Bernstein, CEO and Chief Investment Officer of Richard Bernstein Advisors and a CNBC contributor. I'll get to you in a second, Jim. It's good to see both of you. Rich, I duly noted recently you pulled your horns in a little bit on bullishness. I want some honest answers here. Not that you wouldn't do that, but what month was that? It was about 6 months ago you got less bullish. So
exactly right.
What would you say in terms of the 29% we got last year? You're now looking at missing 15%, would you say? Or
Joe, I think,
what do you think? Is it 15%?
I think from the point of view of managing a portfolio.
I understand there's risk and everything else, but is that about right, 15%?
Yeah, I mean, a lot of our equity portfolios actually outperformed last year.
No, I understand.
The point that I think that people have to think about is, as you get a momentum rally, which I think is where we are, because fundamentals are still deteriorating, do you buy into that momentum rally or do you sell into that momentum rally?
You're managing risk.
Exactly. And I think all we're doing is calming down as we get to this momentum phase. And as the market keeps going up, you just keep lighting up.
You're at a point in time where that still works, that explanation.
Absolutely.
Okay, it doesn't work. You saw Francois Trahan of the UBS. He's been bearish since 2400. So he gets up to 3250. He can no longer say we're just managing risk. Yeah, he needs to throw in the towel, capitulate, and say, I had no idea what I was talking about, which he didn't, obviously. If you get to if we go another 15 and then it's 30 that you've missed, then this explanation doesn't work.
Well, look, as a former sell-side strategist, I can sympathize with Francois, because as a sell-side strategist,
you should never say anything.
Your idea is you have to put an idea out there, you have to differentiate yourself, and you're not being measured in terms of performance per se. As a money manager, you are being managed, relative to performance, both your benchmark and an absolute term. And the only way I can answer is to say that our biggest equity portfolio outperformed, and we're still doing
But you
fine.
may at some point it may go down 15% over the next 6 months, and you're going to be vindicated, and it's going to look great. Or it may go up more, and then you're going to say, geez, I probably should have capitulated back then. Yeah, we don't know at this point.
It depends on whether we can help.
Paulsen, what do you think? Are you going to, I mean, I know you don't need to talk about Rich specifically, but so you did 20, you were bullish all last year, right? And you had been bearish prior to that.
Yeah, in 18, 2018.
So
I guess, Joe,
3,600 this year?
I think it's possible.
Who
knows?
Much.
I by the way, I have high regard for Rich, so
Thank you, Jim.
Nothing but high regard.
Well, that's because why? Because never for the grace of God go you next time.
Well, that's right, and I've been there, and I'll probably be back there.
But if you
before the year's out,
right? But
here's Joe. Here's what I guess I think is, I'd like to see some pressure on the market before I get too overly cautious for this market. In other words, I think that fundamentals might even be improving a little bit right now. We're seeing economic surprise indices pick up. The OECD World Leading Economic Index has bottomed out and picked up. Overall, we're certainly seeing better reports in the United States with a clear acceleration here going on. We might do 2.4% growth for the full year of last year, but against that, what's to take the market down right now? Are bond yields going up too much? Are short-term interest rates rising too much? Is inflation a real threat right now for the stock market? Is there too much tightening by the Federal Reserve? Is there too much tightening by fiscal authorities? Is there truly just over the skis, over the top optimism, full on run into the stock market where everyone's going crazy? I don't see any of that. And I think before we end this run, at least we could always have a pullback, but before we end this run, there's got to be some pressure brought to this stock market, and I just don't see it yet.
So the way I view it, and I should, in the Mutual Admiration Society, point out I love Jim as well. But I think when you manage money, you have to try to say, what are people going to be talking about a year from today? And I agree with Jim that right now there's nothing that's glaring. There's nothing that's saying that we should be under our desk in the fetal position. There's nothing like that. But the question is, if corporate profits don't pick up, what happens to employment? It'll be the second year of basically flat to down earnings for major corporations. I don't know any CFO who says, I'm going to hire people when my earnings are flat to down for 2 years in a row. I think CFOs, CEOs will be under pressure to cut costs, to manage the business better. And, if you think about it, what is the number one consensus is that the household sector's fine. Everybody believes the household sector today is healthy. And that's true, but what people are missing is even in the employment data, ADP yesterday year on year was the weakest it's been in this cycle. And nobody talks about it. And so I think those are the type of issues that you have to put on your radar and try to say, well, people will be talking about it a year from today.
Go ahead, Jim.
But Rich, I think to suggest that growth won't at least stay where it's at, is a big assumption, because look what we've done. We've taken the long-term cost of capital, the 10-year yield, and dropped it in half in the last year. We've exploded the money supply. We've upped quantitative easing. We got greater fiscal juice compared to the GDP by almost a full percentage point. You're suggesting that none of that's going to work. I think a little bit of it's probably going to work and keep us healthy, at least for a while.